oh my god, look at all this money raining down on me. Am I getting all this for free? Oh, but wait a second. If everyone's getting this for free, is high inflation coming then? Hi everyone, my name is Yusing. Come for the wild finance and stay for the lousy drama. Well, lately, everyone has been talking about high inflation, that it's come to stay and gonna destroy your purchasing power. And we have seen no less dramas on the stock market, especially the growth stocks, which have been selling off heavily in anticipation of high inflation is here to stay. Well, it's no surprising because with all the money printed last year and also this year from the central banks all over the world and a near zero interest rate, plus the society is opening up, people can finally go out and spend the money they have been stacking the whole year. So it seems logical to me that with the demand for goods and services are going up, and while the supply hasn't catch up yet, the inflation is on the rise. And in fact, we have seen the data from Consumer Price Index, the CPI, that inflation rate is increasing, especially in the energy sector. Look at the gasoline price increased 49.6% and oil increased 37.3% on a year-over-year base. Ended April 2021, and the used cars 10% increase month over month just in April. Although we need to consider that oil and gasoline prices went to the toilet in March and bottomed out in April last year, the inflation is still real for now. The huge jump in the used cars shows the telltale sign of car manufacturers' supply chain disruption hasn't fully recovered yet. And from the demand side, I know many people, including myself, are planning for the trips and shoppings that are long overdue and are willing to pay a premium price to just get out of the country or home and go somewhere either to meet family and friends or to relax and enjoy and do some shopping. And this short-term sudden increase in demand will drive up the price, no doubt about that. So like many people, I do expect an inflation spike post-pandemic in most goods and services. But I'm not fully convinced that the high inflation will continue afterwards. And I believe we will see an inflation maybe around 3.5 to 4% on CPI all items this year, which is considered high inflation as compared with the Federal Reserve or central bank's target of 2%. And after that, I think we will go back to sub 2% for the following years. Because after the initial outburst of spending, people will go back to normal life eventually, meaning we will travel once or twice a year like we used to do, and we will eat out 2 or 3 days a week like we used to do. It's unlikely that we will eat out 7 days a week forever. I mean, I will get sick of it by eating out for just a month. And from the supply side, since the pandemic, the supply chain has been disrupted and the transportation is generally slower, so the raw materials have been rising in price. But many believe it is temporary because companies are ordering and stacking extra material in anticipation of a higher demand with the society reopening. And since the supply hasn't been able to catch up, the price of raw material is probably going to see a spike in the short term. Although all the data are pointing to a higher inflation, I still think the long-term outlook is not that bad, and on the contrary, maybe even deflationary. Because if the unemployment rate is not dropping dramatically, meaning the wage will not increase dramatically, it's very difficult to get a sustained high demand year over year. Now, why do I think the unemployment rate will not drop easily? The reason is technology and innovation. Most people don't realize that technology and innovation are long-term deflationary to the economy. You see, the speed of innovation and technology happening in our society is on a rampage, and the rollout of those technologies are much faster now than decades ago. Technology provides a higher percentage of automation, so all those automated industries need less and less labor. More and more traditional companies are transforming to digital and automation for cost saving and increasing productivity. I think the pandemic also did a push towards that direction for most companies. And if we see this trend continues, which I think is inevitable, then it's unlikely the unemployment rate comes down. So while technology decreases the cost of production and increases productivity, we will have a stable increase in the supply side. But if we cannot increase the demand due to a sustained unemployment rate, then once the supply and demand balances out after the initial post-pandemic spike, the inflation rate will go back to sub 2%, in my opinion. Now, the supply and demand is just one factor for inflation. And the inflation rate we are talking about here is those items that are included in the CPI basket, like food, energy, apparel, and cars. So you must be wondering at this time, then where did all that printed money go? Now, to answer this, I want to give you a holistic understanding of what are the cause factors of inflation. The number one factor that everyone is talking about is, of course, the money supply. When you increase the total supply of money through quantitative easing, the QE, which is the money printing basically, it leads to people accessing more money to bid for the same goods and services and drives up the price. It is often used as the argument for higher inflation, but it is not the only one. In fact, the decisive factor for inflation is the velocity of money, meaning how fast the same money changes hands. I know it's still difficult to grasp, so let me give you an example here. Let's say in a certain time frame, I spend $100 to buy goods A from person A. And then person A spends the same $100 to buy goods B from person B. And then person B spends the same $100 to buy goods C from person C. And in this way, the same $100 is used 3 times in circulation and creates a total spending of $300. So the velocity of money is 3. Now, if in the same time frame, the circulation of money speeds up, say it changes hands 10 times now, then the same $100 is used 10 times, which creates a total spending of $1,000 and a velocity of 10. You see, although the money supply didn't increase, but by increasing the velocity of money, the total spending increases and it results in a higher inflation rate. So although the Fed has been printing lots of money, but the velocity of money has been going down over the last 2 decades. And that is why we don't see the effect of money printing, because most money printed is not used to purchase goods and services. Now let's go back to the question. If those printed money are not in circulation for buying the goods and services, then where it is? And here comes the harsh truth. Unfortunately, most of the money printed went to the rich 1%. And that is why after the 2008 financial crisis, when the first quantitative easing was introduced, the rich got richer and the middle class and poor stayed the same. You may wonder, why did the rich get money instead of the poor during the crisis? This is because when the crisis hits, rich people, typically Wall Street banks and insurance companies, who are in danger of insolvency, and they get bailed out by the governments in an attempt to stop the business from collapsing. They are eligible for the large sum of cheap loans and other benefits, while the working class has none. So when they receive that freshly printed money, they don't spend it like we do, simply because they can also just eat 3 or maximum 5 meals a day. They will not eat 20 meals a day because they get 20 times more the money. Instead, they invest most of the money into financial assets and real estate that provides them even more money. So most of the money doesn't end up in circulation. They end up in the stock market, in the real estate market, and in the cryptocurrency market. And that's why we see the stock market boom during the worst economic conditions in a pandemic. But now, people are wondering, why have growth stocks been selling off so much? So the rotation from growth to value started in February this year when the anticipation of high inflation started to grow, and recently the high inflation worry got validated by the CPI data. And that's why we saw a further sell-off in the growth stocks. The reason for the sell-off is because if the high inflation continues, then investors anticipate central banks would have to raise interest rates sooner than promised to cool off the economy. And that is bad for those growth companies who have borrowed a lot of money to fuel their growth. So increased interest rate would mean a raise in cost for those companies to service their debts, and also a higher discount rate for their future earnings. So the valuation for growth companies would come down dramatically if the high inflation really continues. And most financial assets that are considered risky will also suffer due to high interest rates, because in a high interest rates backdrop, most investors prefer risk off instead of risk on. So for example, Bitcoin and other cryptocurrencies will be considered high risk and also suffer a sell-off, like we see now in the market. Now you may ask, then shall I sell all my growth stocks and cryptocurrencies now and buy value stocks instead? Well, that's where I would do the opposite. I am buying the dip during this time because while in short term, everyone is panicking about high inflation data, I still believe in the long run, the economy will struggle with deflation instead. Meaning the central banks will not raise the interest rate, and when the inflation cools off, maybe towards the end of this year, and I think the stock market probably would price in already in August and September, then investors will be risk on and rotate back to growth again. And I think the point of change will probably be when we see a decreased increasing rate of inflation month over month. And I think it might already happen somewhere in September this year. But this is pure speculation from me, so no financial advice. Maybe I'm totally wrong and inflation goes through the roof and even goes into a hyperinflation. So the main purpose of this video is to teach you about inflation and what are the cost factors that you should consider when you hear people talking about potential high inflation. If you like this content, then please give me a thumb up, and in my next video, I'm planning to talk about the different sectors to invest under different economic backdrops. So if you want to hear more, then please subscribe to the channel and turn on the notification bell. And that's it for today. I will see you in my next video. Bye bye!